Hi everyone. So I'll briefly introduce myself and then get to today's presentation, which is my thoughts on the most optimal way an individual investor should participate in equity markets. So I'm Jatin Khemani. I run an independent equity research firm by the name of Stalwart Investment Advisors. We are registered with SEBI as investment advisor and we are based out of New Delhi. We blog at stalwartvalue.com/blog. I've often observed around me that investors feel, especially individual investors, have a notion that large companies are safe. And there are various reasons why a lot of us feel that way. We feel the large companies have a proven business model, they have a long operating history, they've already created a lot of wealth. That's how they became large caps. Most of them are professionally run. There's a steady dividend history. Since they're widely tracked, there's a lesser chance of a fraud, so on and so forth. There are a lot of logical reasons we have why we believe large companies are safe. So let's examine that notion. If you see in year 2000, the top 100 companies by market capitalization and compare that list with 2005's top 100 companies by market capitalization, you would see that 41 companies dropped out from that list. So 41 companies which were there in the top 100 companies in year 2000 did not appear in the updated list of year 2005. Similarly, from 2001 to 2006, 33 companies dropped out. And every year you see about 30-40 companies drop out from this top 100 market capitalization list. If you compare Nifty's composition from 2007, you would see that 14 companies out of those 50 companies are no more there. If you compare 2007 going back to 2000, it would not be very different. Again, there'll be a lot of companies which did not make it to this list in 2007. Since inception in 95, there are 113 companies which have dropped out from Nifty. It's probably more difficult to stay in the top than to reach there. Are large companies easy to decipher? So for example, I've taken M&M just for illustration purposes. So M&M has 154 subsidiaries. Yes, I said it right. It's 154 subsidiaries. Over and above this, there are 11 joint ventures and associate companies, which makes the total entities under M&M at 165. So essentially what I'm saying is that if I have to make sense of what's happening in this company, I would have to actually read 165 annual reports. And only then I'll be able to make sense of the moving parts, what's happening where. Further, there are 10 reporting segments under M&M. So there is automotive, technology to financial services, hospitality, infrastructure, and so on and so forth. It's like when I invest in M&M, I'm essentially investing in 10 different businesses. If I have to make sense out of what's happening here, it might take, as an individual investor, 6 months or maybe 12 months to understand what's really happening. And even then, there is no surety whether you'll be able to make sense out of what's happening. Tracking is equally difficult. Since there are so many businesses, so many entities, the accounting also is very complex. Look at Reliance. It's not any different. There are 95 subsidiaries, 7 joint ventures and associate companies, making the total entities under Reliance to be 100 plus. 5 different reporting segments, from oil and gas to retail, telecom. Look at L&D. 150, almost 150 joint ventures and subsidiaries. 11 reporting segments, right from electricals to financial services, technology, hydrocarbon. Please note that I've randomly taken these companies only for illustration purposes. These are great companies, they've created a lot of wealth, but my limited point is that as an individual investor, is it sensible to spend so much time and make so much efforts to understand what's happening here? Whom are you competing against when you are investing in these companies? Top 100, top 50 companies. So in M&M, there are 1062 institutional investors. Those are number of institutional investors, 1062. Reliance has 2200 plus institutional investors. For L&D, that number is almost 1300. These are mutual funds, FIIs, hedge funds, sovereign funds, guys with army of professional analysts, fund managers, dedicatedly looking at these companies day in, day out, and trying to make sense of what's happening. These are the people whom you're competing against. If you see top 100 companies by market cap, 32% of the total market cap is held by institutions. If you see based on free float, which is the public shareholding, total shareholding minus what's held by promoters, of that 72% is held by institutions in the top 100 companies. If you see the next 200 companies, from 101st to 300 by market cap, 25% of the market cap is held by institutions, whereas in terms of free floats, it's 61%. If you go beyond, the number drastically falls to just 9% of the total market cap in terms of what's held by institutions and 22% of free float. And for this table, I have considered only companies which have a market cap of more than 100 crores as on 11th January 2017. And there are 1700 such companies. So in the third row, essentially I'm looking at companies from 301 to 1700 in terms of highest market cap. And there the institutional ownership is fairly small compared to top 300 companies. Let's look back and see how did some of the most successful investors start their career. So if you see the original initial partnership letters by Warren Buffett going back to 1950s, in one of the letters Warren Buffett wrote that for the mutual fund, buying 10,000 shares of General Motors is only slightly more costly than buying 1,000 or 100 shares. In some of the securities in which we deal, buying 10,000 shares is much more difficult than buying 100 shares and is sometimes impossible. Therefore, for a portion of your portfolio, larger sums are definitely disadvantageous. So one thing we can make out from this is that he was surely investing in companies which were micro caps, probably less than $10 million in market cap. And even if you adjust for inflation, even today, these companies would still be micro caps. Would he do it differently today? So somebody recently asked Warren Buffett that if you had to start all over again, how would you do it? Let's listen.
So I read about your investment in Korean stocks for your personal portfolio. My question is, if you're managing very small amounts of money, like say 3 million or 10 million, will you still look for the Graham's approach for low PE and wider discount to book value? Will you still look for these kind of situations if you couldn't find any franchise stocks?
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities. And when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money. But there are compensations to that on the other side of the equation. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in, and I was sort of reliving my youth. Somebody sent me a handbook of Korean stocks and told me that the market was interesting. So one Sunday afternoon, I did leaf through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce. But the stocks as a group were so cheap that you had to make money out of them. They were Graham type stocks, and that's what I would be doing. I would be combing that sort of a list. Now, if I found a wonderful company that Graham wouldn't have bought, but I really was convinced about its future.
So the key takeaway from Buffett's reply on this was, I would do far better percentage-wise if I were working with smaller sums, as you have thousands and thousands of opportunities, whereas with large sums, we have relatively few opportunities to make a real difference to our net worth. You have a huge advantage over me if you're working with smaller sums of money. Charlie Munger seems to agree with him. In one of his interviews, he said, how do you get into these great companies? One method is what I would call the method of finding them small. Get them when they're little. For example, buy Walmart when Sam Walton first goes public and so forth. And a lot of people try to do just that. And it's a very beguiling idea. If I were a young man, I might actually go into it. And there are a whole host of great investors who started their career by doing just that. Peter Lynch is another great example. If you read his book, One Up on Wall Street, he kept talking about getting into smaller companies where other institutions had not found it yet. Why smaller companies? Some of the best performing public companies like ITC, Infosys started as small and micro cap companies. The key is to identify them early. ITC in year 1988 was a 100 crore market cap company. Today it is 3 lakh crore plus market cap. Infosys is no different. Why do institutional investors are not able to be as active here? Because of their size. They are not able to get the adequate position size here. The impact cost is fairly large. So for example, if there's a 1,000 crore fund and their minimum position size is 3%, they would want to have at least a 30-40 crore kind of a position in a company. But because of obvious constraints like impact cost, low liquidity, they are not able to look at smaller companies. This is the key reason why you find a lot of inefficiencies in this pocket, barring some exceptional times, I think, like what we are facing today. Valuations are clearly on the higher side. There's been a lot of demand and not adequate supply, which led to valuations skyrocketing. But barring these aberrations, most of the times you find inefficiencies in the small and micro cap space. I want to briefly discuss here what really goes into making of a 100 bagger. So, of course, there are a whole host of things, right? There is no one answer to it. Business has to be a good business, there has to be a moat around it, the return on capital employed has to be high, it should be generating free cash flows, management should be honest, competent, ethical, they should understand capital allocation, you should get in at the right valuations, so on and so forth. There's a long list of what you would want to look for in an ideal investment opportunity and something you would consider as a potential 100 bagger, right? But if you ask me that, tell me one thing which you think is the most important out of all these things, I would say size of the market opportunity. Because no matter how great the business is, no matter how amazing the management team is, until and unless there is an opportunity to grow the business, and when I say big opportunity, I'm talking about revenues, potential revenues to be 50 times or 100 times from the current revenues. Until and unless that opportunity exists, no matter how amazing the execution is, there will be constraints on how much you can grow. And I have a case study here. So when Ramdeo ji invested in Hero Honda in 1995, this company annually was selling 2.3 lakh two-wheelers. 20 years out, in FY16, this company sold 66.3 lakh two-wheelers. That's a 29 times growth. The penetration of two-wheeler in 95 was maybe 1 or 2%. Even today it is merely 12%. The size of the opportunity was so huge, and this company could capture that, which is reflected in the volume growth, in the sales growth, which has grown 45 times, and eventually the market cap of the company has grown from under 600 crores to almost 60,000 crores. And it has been a 100 bagger for Ramdeo ji. Of course, it's very easy to comment in hindsight. So I have listed out some areas where I'm very bullish, and I think the size of the market opportunity could grow 10 times, 50 times, or even 100 times in the next 2 decades. I'm very bullish on anything to do with discretionary spends. And just to be a bit more specific, entertainment is a space which really excites me. So look at something like amusement park. So in India, you have annually 4 to 5 crore visitors to amusement parks every year. In a country where the population is 130 crore and half of the population is below the age of 26 years. There are 40 crore Indians who are below the age of 14. That's exactly the target segment for an amusement park. And they're not going to go alone, they're going to take their family along, right? And despite this huge opportunity, look at the current numbers. They're nothing. The total size of the amusement park industry in India today is merely 3,000 crore. Compare that with China. It's 25,000 crore in China. Globally, it's a $25 billion industry. There are merely 16 large parks in India today. That's nothing. So I'm extremely bullish on amusement park as an industry. I think at least in terms of opportunity, it's a humongous opportunity wherein we haven't even scratched the surface yet. So is the case with movie exhibition businesses like casino. The other way of looking at size of the market opportunity is, I'm going to discuss that in this case study, wherein Rakesh ji invested in Titan in year 2003. So Titan had recently gone into organized jewelry retailing, and jewelry retailing was already a huge category, but largely dominated by unorganized players. So there were mom and pop stores in every lane, every mohalla of the country, and these were standalone stores. Titan saw a huge opportunity and shift towards organized retail, and the trend that played out there was shift from unorganized to organized. So the market was already very large, and every time Titan opened a store in any area, they kept winning market share from the neighboring local mom and pop stores. The top line has grown 14 times, profits have grown 43 times, and the market cap has gone 100 times in last 13 years. This also happened in paints industry. So if you see paints industry in 1980 was a 2000 crore industry, but the share of unorganized was very high, 60-65%. And it was largely dominated by hundreds of small players. So market was fairly fragmented. 20 years out, industry trebled in size, share of unorganized kept falling. It came down to 40% and consolidation continued. Look at it how it stands today. The industry is 40,000 crore, share of unorganized is further down to 20-25%, and top 5 player accounts for 61% of the market share. Asian Paints alone has 30% market share. So this consolidation played out beautifully in paints industry, And I think we are extremely lucky to be active investors in India today because this is one trend which is playing out in a lot of categories and is a structural theme. I think this trend is going to play over next 10, 20, 30 years. And the opportunity for organized players is humongous. Though these categories are growing at 10, 12, 15%, but since you have weaker counterparts who are not as efficient as you can keep winning market share from them. Give a better value proposition to your customer, have economies of scale, spend on branding, and you have a huge advantage as organized players. And I'll just discuss few categories here. Look at apparel, it's a 1 lakh crore category growing at 8%. 70% is unorganized. And if you see last 5 years, the top 5 brands have compounded at 25% CAGR. So there is a lot of empirical evidence which suggests a strong shift towards organized players. Diagnostics is similar story. The category is about 40,000 crore, growing at 16 to 18%, and half of it is dominated by unorganized guys. So players like Thyrocare, Dr. Lal, uh, these guys are able to grow much faster than the industry growth rate of 16 to 18%. And that is true for a lot of other categories as well. I've just listed out a few of the categories here. And in my previous video presentation, I had covered all these categories at length one by one, and this video can be found on our blog. So far what I've covered is that uh, an individual investor should focus more on emerging companies and not on larger companies because they are complex. They are already well invested by institutional investors, and then I touched upon how some of the most successful investors started their career, uh, and essentially I was trying to convey that the right way to invest for an individual investor is to focus on small emerging companies. Uh, but then a common concern raised by most of the individual investors is that I don't have enough information. How do I analyze? How do I build conviction? And there is these companies are not sharing enough information. So let me do a quick poll. Uh, what do you think? How many companies in India, listed companies in India, do a quarterly conference call? Think about it. Do you think it's less than 200? So it's largely the top 100, top 200 companies which do conference calls? Is it more than 200 and less than 400? Between 400 to 600? Or the number is more than 600? Take a moment and think about it. We did a poll on Twitter, and about 450 odd guys participated in the poll, and I would assume most of them are active investors, active individual investors in the market. And about 63% of the people said they think it's less than 200, and 11% it's more than 600. Well, the correct answer is more than 600. So as on Q2 FY17, there were 610 companies in India which did a quarterly conference call with analysts and investors. I have asked this in other forums and the answer is not very different. I see very few hands for more than 600. So the perception is that very few companies are sharing information regularly. Over and above this, there are 100 companies which share investor presentations after every quarter. And these presentations are fairly detailed. They talk about the quarter gone by, operational performance, outlook, so on and so forth. Over and above that, there are 150 companies whose management comes on TV, business channels after every quarter, mostly after every quarter, and talk about the quarter gone by. So about 600 companies which do regular conference calls, 100 sharing investor presentations, and 150 sharing management commentary through TV or print. That's about 850 companies out of total investable universe of 1700 companies if you assume companies with more than 100 crores market cap. That's 50% of the companies, right? That's a fairly large number. So the perception that it's only the top 100 or top 200 companies sharing regular information is misplaced, is not right. We have a lot of information being shared with us in a very timely manner. And the tool which I'm sure a lot of you would already be familiar with is Research Bytes. So whether it's conference calls, whether it's investor presentations, whether it's any management appearance on any of the TV channels or print media, you get all the information from this portal. The good news is this is free to use. You can sign up and make a watch list. You'll get an update every day about any new resource being added to the portal regarding your company, and you also get to know what time the company is scheduled to have a conference call, what number you have to dial in, and I would encourage you to participate in these conference calls if, as an individual investor, you want to have conviction and track the company closely. This gives you an opportunity to talk to the management, ask them tough questions, and if at all operator tells you this call is only for analysts, it's okay, hang up and call back as an analyst. And that should be the way, right? Ultimately, the call is for the benefit of investors and analysts, not just the analyst community. So I think as investors, you have every right to participate in the conference call and not be dependent on the brokerage result updates. The next source of information I'm going to talk about is Scuttlebutt and common sense. Uh, all of us have it, all of us can use it, but unfortunately, very few of us leverage this tool. I have put some names on the screen. These are companies which I'm sure touched our lives, and we experienced them as consumers at some point in time before we got to know that these are such great companies and they created so much wealth in last 5-10 years. Uh, so my limited point here is that if you stay curious, if you stay alert, if you observe trends around you, consumers around you, if you uh, talk to dealers when you're shopping, when you're just going out to do research, I would encourage you to talk to dealers. They know so much about what's happening in the market. Ultimately, things happen on the ground first before they're reflected in numbers. Uh, High Street can tell you so much more, and before the Lal Street gets to know that. So that's something I think we should really leverage. The next point I want to discuss is about industry exhibition. So this is something which has really worked for us. I've often met top managements in industry exhibitions, the CEO, MD, Chief Marketing Officer, Chief Financial Officer, uh, especially in small and mid cap companies. I often find top management to be present at the stall, very open to talk. They're there to meet the other stakeholders, very open to talk, and a great platform to actually meet the company, meet their competitors, meet their suppliers, their customers if it's a B2B business. So you meet the whole value chain in an exhibition, and I think it adds a lot of value. Many times they have their products on display, uh, and you have the top guys from the technical teams, from the marketing teams present there. They're there to meet you and other stakeholders, so they're very open to take your questions, explain the product, the value addition they bring, and I have found it to be extremely value additive. I've often heard individual investors complain that they can't access management, unlike other HNIs and institutional investors who can meet the management in between the quarters and they have edge, they have information. I say that you have an equal right to meet the management, but obviously they cannot meet all the individual investors. And if they keep meeting everyone, when will they do the actual work? They are at the end of the day running a business, and they have to keep their focus on uh, the factory, on the market, manage their employees, get the business, and not just keep meeting investors, right? So obviously it's not practical, but there is a great platform for shareholders, for individual investors to meet the management, and that is in the annual general meeting. Uh, I have been to at least 5 AGMs where I was the only shareholder present, only shareholder. And these weren't micro caps of 10, 20 crores market cap. These were companies between 100 to 1000 crore market cap. There was a company with 1000 crore market cap where I was the only shareholder present. I've been to at least 20 AGMs where there were less than 5 shareholders present. Uh, I've had a great experience attending AGMs throughout the country. Me and my team, we attend about 40 to 50 AGMs every year, and we try to cover newer companies because we find that's a great way to meet managements. And more often than not, these AGMs happen at the registered office, which is generally their first factory if it's a manufacturing company. And many times on the spot, we requested management to show us the plant. And there have been times when management sat with us for 2 hours, 3 hours, 4 hours after the AGM and explained us the whole business and helped us uh, understand, and they addressed all our queries. So, in my experience, attending AGMs has been very helpful, and I would encourage you, if uh, you are seriously investing, and if you're a full-time investor, or if you can uh, if you want to do it yourself, then the best way is to do it properly. And if access to management is important, then AGM is the best way to actually meet them. In some cases, there'll be issues also. AGMs might not be that great, and management just walk out after the AGM. But in a lot of cases, uh, I've been very surprised with the way managements have attended us and addressed our queries. And every AGM season, you can buy few shares in your watch in companies which are there in your watch list. So we do that. We have we buy few shares in more than 100 companies every AGM season, so that we are eligible to attend the meeting as a shareholder. Prospectus is another great source of information which is often underappreciated. This is a document which is a mandatory document a company has to file with the with SEBI before they come with an IPO or anytime they raise money again. This goes into 400s and 500s of pages. Uh, this document actually gives you entire history about the company, when it started, who started it, what's his background, any litigations going on any of the properties, on any of the promoters, any wrongdoings the company was ever involved in. So this gives you a lot of information, and especially on the industry. So I've often heard, okay, we got the information on company, but how do we know about the industry? When I did my previous unorganized to organized research, I one common question which a lot of people asked me was, how did you get to know about the industry size? So this is one good source on industry. So you get to know how big is the industry, what is the industry structure. More importantly, you get to know who are the other big players. So then you can get into the peer comparison. Sometimes you get they throw names of unlisted companies on you, and then you can even research those private companies. Uh, Risks, that's an important area. So this, since it is a mandated document and there are guidelines on how you have to cover risk, so even the smallest of risks are very properly covered in this document. Uh, I think at least 10-20% of the document must be talking only about risks. They go into that much depth. So as an investor, you really get a hang on what can go wrong in this company, what can go wrong in this industry. And then they obviously cover the regulations part too. Finally, credit rating report is another document which is widely available, but again not widely read. Uh, there have been a lot of small cap companies where even after uh, making a lot of efforts, we were not able to find what we were looking for. But then we got our hands on a credit rating report, and that had that information. Ultimately, credit rating reports are similar to equity research reports, right? It's only the perspective which is different. A credit rating guy is analyzing the company from a lender's perspective, whereas an equity research report analyzes a company from an equity shareholder's perspective. But more or less, the fundamentals involved in analyzing are pretty much similar. So, especially the kind of information like any issues on the operations, client concentration, pricing power, volatility, reasons for volatility in margins, if any. These are kind of information you would find in a credit rating report, and I've personally found it to be fairly useful. And thanks to Screener.in, you don't have to look too far. You just have to go on Screener.in, type the name of the company, go down, scroll down on your bottom right, you would see the credit rating links. So that was about the information. I think I hope I'm able to share that there is ample information available, and that is not a problem anymore. The other concern about smaller companies most individual investors have is that they're so illiquid, they're so volatile. When markets fall 20%, these companies go down 40, 50, 60%. But I think that's precisely our advantage, right? As individual investors, since you don't have to buy for an army of investors like a mutual fund or an FII, you just have to buy for yourself. And even if your portfolio is like say 100 crores, uh, uh, you don't have to really worry too much about illiquidity, because uh, that's not really a risk, right? The risk is permanent loss of capital. You have to get the business right, and if that is done right, and even if your position is down 40%, the right question at that time, the relevant question at that time would not be whether to sell or not, but to whether add or just sit tight. So as individual investors, I think we should work a lot on the company before buying it. Not worry about illiquidity or volatility, but worry about being right about our assessment and the fundamental value of the business. I recently read this book called Buffett and Munger, A Study in Simplicity and Uncommon Common Sense, written by Peter Veblen. This is a beautiful book, and I would highly recommend you to read it. The book is actually a compilation of everything Charlie Munger and Warren Buffett has ever said about a lot of important uh, areas in investing and beyond. And I think it's an amazing book full of wisdom. Uh, so I'll just briefly cover how not to get killed in investing. A lot of people have lost a lot of money by investing in small companies. So I'll just briefly cover what one should avoid, and thereby increase the probability of making it big. So how not to get killed in investing? Avoid commodities. Stay away from nature. They are highly cyclical, highly volatile, uh, totally dependent on demand and supply, and just one variable, price. These companies do not really control anything beyond cost, for which they get into economies of scale, and then when the trouble comes, that also comes in a big pack. So there's no way on earth, I think, anybody can predict where crude is gonna be. When it was at 80, people are talking about 100, then it fell to 50, then 28, people are talking about 20, now it's back to 60. So I think there is no, it's not worth it in terms of predicting where commodities are going. These are at best momentum plays. These are at best trading bets. If at all you do, I don't do that. But if you do, these are at best those candidates. Surely not buy and hold. Commodities over a 5, 10, 15-year period do not create any wealth. They are very cyclical. There are good periods and then there are bad periods. And net, somebody holding on for something for 10, 20 years honestly hasn't created a lot of wealth. So is the case with state-run enterprises. I think we all understand the inefficiencies which exist in state-run enterprises. PSU banks is a classic example. Uh, and there are a lot of structural reasons why that problem exists. And I don't see any reason why that should change. Again, something which is very cyclical. There'll be times when it'll be like below book, like current times, and it'll enter good cycle. And you can play those cycles if you are into those kind of things, those kind of investing strategies. But again, not something which where you buy and hold for long term. Over long periods of time, most of the state-owned enterprises have failed to create wealth. In fact, most of them have destroyed wealth. So that's second kind of companies we should stay away from when investing for long term. In that, avoid highly levered businesses. Uh, Leverage looks good in good times. It helps you grow faster. There is trading on equity. You pay 10% interest, but you make 20%. So do you bump up your ROEs? But what happens in bad times? In bad times, it backfires. It takes away your staying power. Lenders force you to liquidate your assets, and one bad cycle can wipe you out. So any business where you think debt equities are high, anything over one, and interest coverage ratio of less than five is kind of risky. There are only two reasons why such a situation would exist. Either the business is growing faster than what internal accruals can support, uh, uh, so that shows aggression on the part of promoters, may not be always good. Second, if the business itself is very capital intensive, and again something and in those cases generally those businesses are supported by a lot of debt, and that's something we have to be careful about. Avoid tips. You have to stay in your circle of competence, invest in what you understand. uh, if you don't understand it, and no matter how much it is going up, you are better off staying away from it. So if you don't understand pharma, if you don't understand specialty chemicals, if you don't understand IT, uh, no matter what kind of return potential it has, it'll be speculation for you if you invest in it. It's not investing; it's speculation. Uh, one should stay in the circle of competence, which is nothing but area which you understand, where you can see things 5, 10 years out, and and that is real investing. Otherwise, anything else you do is pure speculation. Avoid putting any money where you might need that money within 5 years. So minimum investment horizon in market should be 5 years. In my previous slides, I mentioned why volatility should not be looked upon as a risk. That's only when your investment horizon is minimum 5 years. If your investment horizon is shorter, uh, or you're leveraging, then that volatility becomes actual risk for you. So that mark to margin is becomes your actual loss. Your notional loss becomes your actual P&L loss. So you might have a lot of money in your bank account right now which you don't need for next 1 year, and you might be tempted to invest in markets. uh, I would say think about the capital protection there before thinking about the return potential. So in next 1 year, markets might give you 20-30% the way it is going up, but it might go down 30% too. And you already have a commitment in to put that money somewhere. You might have to give down payment for your house, you might have to buy a car or any other commitments you have, and at that time, since you would not have staying power, you would need money for that thing. You would have to book your losses if markets are down. So that's again something which is speculative, and one should control that greed and focus on capital protection rather than capital returns. Avoid leverage. Let it be slow and steady, even if you have small capital, but leveraging should be avoided at all cost. Uh, it's lethal, and the way markets are so unpredictable, so volatile, a fraction of a second, and uh, entire portfolio can be wiped out. We all know what happened in November. Who could have seen demonetization come? So that's a live black swan all of us experienced recently, right? And markets are back to normal now. January, February has been great, but imagine people who were leveraged in November, December. Uh, there would be so many people who were leveraged and would have lost big time even on uh, good bets. So you might think that, okay, I can't go wrong here, let me leverage, but you never know what's coming. In the short term, it's impossible for anyone to predict what's going to happen. The people who say they don't know it themselves yet. So you're better off avoiding such people, and make it a rule that whatever you have in your pocket and whatever you can let be in the market for next 5 years, only that money is going to find way to equities. Everything else should stay in fixed income or uh, gold or any other asset class you prefer, which is safer in the short term. Stay away from managements with poor capital allocation track record. Now, there are a lot of great businesses in India where you see the characteristics of the business in terms of moat, in terms of pricing power, in terms of first mover advantage, market leadership, ROCEs, debt free balance sheets, but yet no wealth creation for minority over 5, 10, 15-year periods. And what did drive that? I think poor capital allocation track record by the management. This is a fundamental driver of long term wealth creation. These businesses might be generating a lot of wealth, but would it reach minority or not is ultimately dependent on the understanding of capital allocation by the promoters, by the management teams. And to understand it well, if you have interest in this topic, I would recommend reading a book called The Outsiders by William Thornick. Basically, he has profiled 7 outstanding CEOs of America over a 40-50 year period, including Warren Buffett, and explained how capital allocation contributed to the wealth these businesses created for their promoters, for minority. And in Indian context, these businesses would not. These businesses might be creating a lot of cash, might be generating a lot of cash, but if promoter is not giving it out as dividend or doing bad acquisitions uh, just to avoid giving it back to shareholders and those kind of things, they'll eventually destroy wealth no matter how great the businesses are. So you should stay away from such managements irrespective of the fact that you like the business. Stay away from managements where you see corporate governance issues, and top of all is when you see a related party transaction, that too with entities owned by promoters in similar business. Now that is the biggest red flag. So in annual report you would find it. It's a mandatory disclosure, and if there are private companies which are 100% owned and in similar business dealing with this listed entity, there is no way on earth we'll be able to find out whether there are transfer pricing issues, what's happening in both the companies, how is the cost shared. Those are big red flags. How do you find out more about those private companies? So you can always fetch the reported financials from MCA, but I find that a bit difficult to do. Given the kind of website it is, it's a bit difficult. I find it a bit difficult to operate. I use Toffler. So by paying a very nominal fee, you can pull out financials of last 5, 10 years for any private company, and you will be able to make sense of the scale of those companies. Is it uh, just that portion which is reflected in the annual report, or uh, do they have a larger scale? And then you'll be able to do a comparison with the listed entity, and basically there'll be a clear conflict of interest if that's the case, and those companies should be avoided. Avoid promoters where you don't see any skin in the game, and management teams. So you don't wash a rented car, right? Uh, then we shouldn't expect managements and promoters to put their blood and sweat and share everything with the minority without them being benefited out of it. So if the promoter holding is very low, he's not going to get his fair share according to him in the reward. So then he's inclined to draw very high salaries. He is inclined to siphon off money in other ways, do inorganic acquisitions and then do siphon off money, do capex and then siphon off money. So there are various mechanisms a promoter can do that. And then if shares are pledged, then also there is a risk, and so you have to be very cognizant of the fact whether there is skin in the game or not. I like owner operated businesses because of the fact that there is a lot of skin in the game, and especially if it's first generation entrepreneur. uh, I really get excited about the opportunity. There were a lot of companies in 1990s which got listed. Most of them were owner operated. They just got listed in the boom. They did not realize what it means to be a listed company. They continued to operate as a proprietorship or a private company. The idea was to underreport profit so as to save taxes. The idea was to just think about the promoter group interest and not minority. But I think things are changing. Uh, why are things changing? In a lot of these cases, next generation is joining. These are educate. They are much more educated. They understand what it means to be a listed company. Moreover, they have seen their peers really make it big. There is the realization that by showing actual profits, the delta you make on the market cap is much superior than what you make by siphoning off pennies. And also, uh, because of GST, because of demonetization, I think incrementally in this country it would be very difficult to uh, deal in cash, to store cash, to invest cash, and hence lesser incentive to siphon off. Uh, so in 70s, 80s, 90s, there was a crazy euphoria for MNCs. I remember my uncles, my dad, uh, my relatives investing in Bosch, investing in Colgate, Unilevers. There was a huge uh, preference for MNCs. I see that changing. I think the owner operated businesses, the entrepreneurs of Indian origin, the entrepreneurs uh, will be preferred, and things are changing for the better. Next, I briefly want to discuss about portfolio management. So this is a fairly debatable topic. You see very strong arguments on both the sides of the table. There are a lot of great investors who have created a lot of wealth from a diversified portfolio, and then there are equally great investors who created a lot of wealth through concentrated portfolios. So it's fairly debatable. But I would say there are always unknowns. No matter how much you work on a company, how much research you do, spend 1 year, 2 year, no matter what, there are always unknowns. There are always black swans. We are not controlling shareholders, and we don't get to decide the strategic decisions. So I think one should avoid both extremes. There should be reasonable diversification, and I think at about 20, 10 to 20 positions, one is reasonably diversified. Beyond 20, it is fairly difficult for an individual investor to track those positions closely. And less than 10 could mean slightly more concentration. Uh, so my suggestion is have a balanced approach when it comes to portfolio management, and buy and hold, not buy and forget. Ignorance is definitely bad. So you can't ignore the portfolio. You have to track it, but uh, not too closely too. So don't be too fixated on quarterly numbers. Avoid news and macros. All news are important for traders, but for investors, 99% of it is noise. In 1990s, access to information was key, but I think today, filtering, the ability to filter is the key. We are bombarded with information day in, day out. There are thousands of sources, emails, WhatsApp, meetups, newspapers, videos. You're bombarded with information day in, day out. And you must read this article by Rolf Dobili. He's the author of Art of Thinking Clearly. The title of the article is Avoid News. It's a beautiful article, systematically, logically tells you, explains you what kind of effect news has on your rationality, on your thinking ability, uh, kind of biases it create in your mind, and the kind of share of mind it takes. So it's a beautiful article. I would strongly recommend you to read it. I think we should stop chasing news. We should avoid following news. Let it find you. Of course, you can't stay in a shell. You can't, being investors in listed equities, you can't just shut off the whole thing. But there should be a method in that madness. What I follow is Google Alerts, and I'm sure a lot of you must be following it already. So when I'm looking at a company and I'm putting it either in my tracking list or investing in that company, what I do is I put name of the company, the promoters, management, key brands, their competitors, uh, all of that in alert, and you can set up a time every day. At that time, it'll send you a mail with anything and everything written about those keywords on the web. So it could be media appearance of that guy on TV. It could be a blog written about that company. It could be some savvy notification. Anything and everything written about those keywords which you're putting there will reach your inbox at a time when you want it to. And you can spend 10 minutes and then be aware about what's happening in those companies and industries and those specific areas. So rather than you chasing the news, let the news find you, and only the kind of news you are interested in, not random news. Other tools I use, I mentioned researchbytes.com, so you don't have to watch TV. I don't watch TV at all. So even if the promoter or management of the companies you've invested in are gonna come on TV, ResearchBytes is gonna send you a notification that, and with the video link, so you can see that. For exchange announcements earlier, we had to go constantly on BSE and check if the results are announced, if there is any other announcement. BSEalerts.in is another great tool. You can make a watch list there about the companies you're tracking and invested in, and any BSE announcement made by these companies will reach your inbox uh, real time. So essentially, there are three advantages an investor has. Uh, it is information, which is the focus area for this presentation. As I've cleared that there is enough information available out there. I think information is more and more getting democratized. In fact, there is too much of information, and access to information is no more uh, an advantage. Uh, so that's one. The other is analytical. So when you look at the same information, but you analyze it in a superior fashion. I think here professional investors, institutional investors, analyst community has a slight edge because that's their bread and butter, that's their job. They're doing this full time, 24/7. Their backgrounds are such. Uh, so stay away from complicated stuff. Wherever you think, there are too many moving parts, diversified businesses, lot of export import, currency, forex, accounting is complex, too many subsidiaries. Wherever you think that this is too complex, I don't have an edge here, stay away from that. In analytical, I think institutional investors have an edge over individual investors. And final is behavioral. which has to do with your patience, which has to do with your size. Average holding period of a mutual fund in India is less than 2 years. In US, it is less than 1 year, and it is falling dramatically. Imagine that much churning in the portfolio, so much for the long term. Amidst this madness, amidst this craze for what's going to happen next quarter, next year, if you can think 3, 4, 5 years out, I think you have a very big advantage over everyone else who's focused on what's going to happen next quarter, next year, next half year. And size. The smaller the portfolio, the more is the universe of companies you can invest in the sense you can target to invest in. You can even look at smaller micro cap companies without violating the age old principles of value investing and long term moat investing. You can find these amazing companies early, and that's a huge advantage. If you don't follow Ian Cassel on Twitter, I would strongly urge you to follow him. He is an investor based out of US. He runs a portal called MicroCapClub.com, and I don't know anybody else who can write so much wisdom in less than 140 characters. So I'm just quoting one of his tweet here, and that's my goal is to own the smallest, most illiquid, least institutionally owned, best businesses I can find that are run by intelligent fanatics. That says it all, right? That covers the investment philosophy of investing in microcaps from all the probable angles, right? And his blog is equally fascinating. He writes about investing in microcap companies and art of holding, art of selling. He's covered a lot of interesting uh, areas on investing, and they're very inspirational, very motivating, very thoughtful. I would strongly urge you to follow him on Twitter and follow his blogs. So, to summarize, individual investors should prefer to avoid large companies. They're fairly complicated, and you don't have an edge here. If you have a compulsion to invest, do it via large cap mutual funds, uh, and channelize all your energy into finding emerging companies, tomorrow's blue chips. Even if you find just one, right? That's life altering. That's all one needs in the entire investing career. If you have 100 bagger, that's going to alter the orbit. So, and if you can't find reasonable bets, like I'm sure a lot of individual investors are struggling today to find reasonable bets in smaller and mid cap space today, it's better to sit on cash rather than investing in nifty 50 companies. Thanks to technology and stricter regulations, I think information is getting democratized. One should leverage it. Finally, use size and patience to their advantage against institutions. Thank you for watching the presentation. Do share any queries and thoughts you have in the comment section below. Thank you.